So where do we stand now? You've warned about underwriting. How poor does it look?
Sure. So I think what we're starting to see is just a normalization in this space. For far too long, there was lax underwriting standards in direct lending, and with too much leverage put on companies that really didn't need that much leverage on them. What we're seeing is not really a crisis, though. What we're seeing is a cooling in this market, and what we're seeing is a move in default rates from low single digits, call it, it was 1% to 2% a year, moving up to probably 4%, 5%, 6% a year, which brings your returns in this space from what it was as great years of 10, 11, 12%. Returns are going to be in the mid-single digits now. So it's not that necessarily things are hitting a wall and that there's an extreme crisis in direct lending. What there is, though, is a realization that returns are not going to be as perfect as they were for long. Now, of course, there are also the questions around what happens with some of those software exposures in direct lending? What happens with some of the cyclical energy and consumer-related names if we do see a protracted crisis in the Middle East, and a realization there that things have to work really well for direct lending to deliver those high returns that they have over the last several years, and that's what the market is grappling with now.
Well, let's talk about the consequences of that, Christian. If some of that does come true, where you see issues around software, for example, what do the consequences look like for the industry?
Well, what's going to happen in software is going to be a very mixed bag. There will be many software companies that do extremely well with applying AI tools, and you could say even the majority will do quite well. The problem is that in lending, the majority isn't good enough. You need the vast majority to do fine, because all of your upside is getting the yield on your loan. And if any of them go bad, of course, then you start to lose money. And that's probably what we're going to see, is that over time, there are going to be winners, great winners, and there are going to be losers. And those losers, unfortunately, will have very low recovery values because they're simply going to be eaten away by AI. It's probably too early to say exactly which ones those are going to be and how big it's going to be. But in an industry that has 20, 30, sometimes even more % of their loans in software, you have to imagine that some significant part of that is going to get into trouble, and there will be losses in that space. How long it takes and just how bad it is going to be seen. And unfortunately, you've got a lot of investors who'd rather not wait around to see how bad it gets.
Is there any concern that this could morph into a structural issue? Christian, Bill Dudley says, no, this won't turn into another 2008. I guess the major systemic problem is if insurance companies have too much of this stuff and it starts to go bad.
Yeah, well, we always, over all credit cycles, you always have to look for leverage on leverage. And that's, leverage is okay, borrowing is okay. It's where you borrow to make loans that can be difficult. And that was the hallmark of 2006, 2007, and going into 2008, is there was that leverage on leverage, especially short-term borrowing against longer-term assets. It's night and day different today in terms of the systemic risks that we saw in 06, 07. There is borrowing, there is leverage on leverage, and that's an important area of focus. Insurance companies, some insurance companies are exposed to that to some extent, but it is nothing like what we saw with the banks and with the securitization problems that we saw in 06, 07. That said, you could still have real second-order impact here from a credit tightening, and that credit tightening will come. There will be less and less growth in direct lending. There will be less and less growth in lending below investment grade, which has been the source of credit extension over the last several years as households have been paying down debt. Corporates have been levering up, particularly below investment grade corporates, whether it's private or public corporates, and that is going to slow. It's slowing already. It's going to continue to slow, and that credit tightening is going to trickle out into the rest of the economy. Now, that doesn't necessarily mean that it moves into a very serious shock to the economy by any means, but we have to be realistic that this has been the source of credit growth in the economy over the last several years, and it will be a source of credit tightening for the next years to come.
So there's some real economic consequences of this, Christian. I also just wonder, you've talked about this idea before that it's not just an image problem, it's a fundamental problem too, again, going back to the bad underwriting. But what you're also describing is a return to normalization and a credit cycle at the very point that everybody is trying to sell to retail investors. What happens if there's an erosion of trust?
Sure. Well, what happens if you play this forward is that, the default rate may not be that bad and the returns may not be that bad, but there will not be growth in the stock of investment in this space. That is slowing fast, and it may even be negative in some places. And that's just going to mean that it's going to be that much more difficult for troubled companies with maturities of their loans coming due to be able to renew those loans. And that's how this accelerates some of this normalization in default rates, and we'll keep this default rate in this kind of mid-single digits, not just last year and this year, but out into 2026 and 2027 and 2028 as well. So you're going to have this multi-year, not an extreme peak in defaults, but a multi-year process of burning through some of these weaker loans. And that will be driven, of course, because there's not going to be the net new buyer of these loans. If anything, there's going to be a retreat of capital from the space.
But actually, I was wondering about just that, Christian. I mean, aren't there opportunities here after, Boaz started offering 60 or 70 cents for some assets? We heard Robin Dumar yesterday. He was pretty excited about putting cash to work here. Said a lot of stuff looks very interesting lately. Do you see the same opportunities?
Well, a lot of the loans that are out for sale right now are pretty bad loans. So, we've seen some blocks of those, and they're not clearing at a price where we would be interested in buying them. This is becoming more of a distress type of opportunity. And in those areas, you really need high teens type of returns to make them make sense. But what's interesting, I'd say, is that it has refocused the market on other opportunities. And a credit tightening somewhere will lead to a credit tightening everywhere. And what we're seeing is emerging opportunities in what's called asset-based finance. So this would be residential mortgages, this would be consumer lending, this would be aviation finance, things like that, where that's a much more resilient profile. There's been much less leverage. In fact, there's been deleveraging in those spaces for the last several years. But when the system as a whole has a credit tightening, that creates a higher cost of borrowing for the system as a whole and creates more interesting opportunities in those higher quality opportunities that are kind of babies getting thrown out with the bathwater. So that's really where we're looking for the most opportunities, rather than pivoting into distressed sectors and trying to guess which software company is going to be the survivor.
Christian, we only have a minute here, but I want to ask more about this tightening, because you've also seen in public credit markets and leveraged loans that there have been wobbles there. JP Morgan, for example, pulling back on debt that they were of Qualtrics that they were going to put into the market. What sort of mix does that create? And is there any degree where that could be a saving grace for private credit if more public and liquid markets start to pull back?
Well, it's really interesting. I mean, what we're seeing is a divergence in quality and performance, fundamental performance, between IG and high-yield bank loans direct lending. Most, if not all, IG software companies are going to do just fine through the AI shock. And so to the extent that this credit tightening drives spreads everywhere higher, including in investment grade, it creates that much more of an interesting opportunity in investment grade, where there isn't much real risk of fundamental impairment and defaults, the way that there really is in some of the more levered spaces in direct lending.